Hi, this is Wendy Kirkland. This is the second DVD where we will cover patterns other than the P3 and the P3.5, which were covered in the first DVD. There will be a third one, and that will cover the last strategies that were in the book. So we'll take this just as we did in the first one. We'll take this step by step, and we will run through the various strategies so that we can kind of talk through them and that you will be able to get all of the details fixed in your mind by actually seeing how they play out on charts that have colors rather than black and white. The chart indicator lineup for these strategies is exactly the same as the ones that were available that we set up on for the P3 and the P3.5. The EMAs are the same, the pivot points, the RSI, the commodity channel index, the CCI, the ADX on the top of the PPO, and the ADX on the bottom. And for one of the strategies, it's an 8 cross of the EMA over the 13, and sometimes the other EMAs being on the chart can be confusing, so we will remove those and just concentrate on the 8 and the 13. And even though we're not going to be using all of the other indicators, it sometimes is helpful because you now know and recognize the P3 and the P3.5 pattern, and it's interesting to see how those play out in the middle of these other strategies that you can use in the different time frames. So let's start looking at some charts and we will talk through this. This is the 8 and 13 EMA chart, plus it has the pivot points, and as you can see I have removed all of the EMA indicators except for the 8 and the 13, and I did this just so that it wouldn't confuse the eye as far as actual looking for crosses. So down here, before we can see the current time frame or the time frame on this chart, there would have been a cross up of the 8 over the 13, and here is an area where you can see there was some price drop, but the 8 did not cross over the 13. It just was a test of that support line. Here's a little tiny area also, and it incorporated 2 red candles, and the cross actually took place right here. So this is an indication that here we've had a nice long uptrend, and this cross actually took place at this point where you can start seeing some white space between the lines, and we're looking for actual crosses. There was a almost cross just before that period that we were just looking at. There was a little test right here to say, you know, do you really mean it? Are we really going to cross down, or is this just another test area? And then it did cross. Here we have an area that it looked so much like it was going to cross up like this. We've had 3 strong candles, but it actually did not put any white space between the lines. This is almost like the PPO skid lines that I was talking about in the last DVD, where I believe that the 8 EMA probably did rise where it's just barely on top of the 13, but did not put any white space between the lines. It was just a little slide over that went a little too far, and then we continue the downtrend until there's actually a cross up here and with some white space. Here we have a touch, and then it continues up. So each of these touches is actually testing support or resistance, and for the sentiment of the market to decide whether it is done with that trend and ready to change and move on to something different, or whether it's just testing and saying, you know, we're just really not quite there yet, and it will continue in the direction that it has been. I'm pointing out that here we have a squeeze that has been forming. There was an area here where it looked almost like that it was gonna, the PPO was gonna cross up, but it didn't. But here it actually did. Now this squeeze, we are not trading the squeeze pattern. In this particular strategy, we are actually going to be trading the 8 crosses of the EMA. We are keeping it very simple. That is our a very clear signal for in and out. We'll also be using the pivot points, but you can't take away the knowledge that you have already gained, and that's kind of the point of being able to look at a chart and be able to see all of the things that are taking place. So here we're looking at a chart and we're looking at specific 8 and 13 EMA crosses, but we can also see that we have a P3 pattern that has formed here, and that we've just had would have had the entry for it. And looking at the chart, we can see that there's one of those stage 5 toddler wobbles. The lines are spreading apart, but it had to come down here and test the signal line before bouncing up. And this is where I was saying on the last DVD, you will get to the point where you can just look at the chart, this pattern will jump out at you, and you will instantly be able to look at it and see exactly where, whether it's a P3.5 or a P3, you'll be able to see just exactly where it is in its life cycle. Now, here we are discussing the 8 and the 13 EMA crosses. We had a cross right here and we had a test, and now it's continuing up and has kind of broken out above this previous high. This is a weekly chart, and I have placed this one here so that we can see what happens when there is kind of numerous crosses. There was one here down, here's one up, here's one down, here's one up, another one didn't quite go down, but then more distinctively going up. And then there's some over here where it crossed down, here crossed back up, crossed down, crossed back up. And this can happen in areas of consolidation, and these areas, as they're taking place, it's not like something that catches you by surprise. The first one might, but there's enough indicators on the news and so on, and you can certainly see that this was a period where the Qs and the NASDAQ would have been trading within a very narrow channel. Now this, I can maybe see it with my eyes, 57.50 down to the 52 area. That's a $5 trading range that it was in for almost all of 2011, and it wasn't here until 2012 that it broke above that range. Now, certainly there was some money to be made here in these drops as it dropped down and went up again, but this is an area where it's evident what is taking place, that there is this braiding that's happening in the DI lines where one's up 1 week or 1 month and then down again, and they're shifting and jockeying for position, and neither of them have taken control in the way that you see here. This one, the plus DI line, is definitely in control. The minus DI line is headed for the trees. It's out of the picture. Here again we have some braiding that is taking place, but a little bit more decisiveness that has moved in. The trends are not real long, but enough so that you can more clearly see the crosses, and the moves are a little bit more distinctive. Now, during this period of time that we were consolidating, and this congestion and all was taking place, there was a P3 that was forming. And you can see all the different tests here of the signal line, and this would have been kind of a small P3.5. There's just a little area where the lines are spreading apart. But this is the P3. You have the P3, the PPO cross up, and it running through the 7 stages here. And you can see that there's the wobble, and then you go into the 6th stage of the parallel lines, and then here's the expiration of that pattern. So I've kind of gotten away, but throughout this now I want you to start picking out the different patterns and seeing how they provide additional information that if you were considering getting into this cross up of this 8 over the 13, you could easily sit and say, look down here and say, well, this is a P3 that's unfolding, and the stock is just coming off of a wobble against the signal line and is getting ready to go into the stage 6, the adult stage, the sweet spot. By all means, that is a good confirmation for getting into this trade as the 8 crosses over the 13. Where if you were considering getting in on a move down here, or there's not a cross, but say right here you were thinking about getting into this cross down, you could look and say, well, is a P3.5 taking place? You know, what supporting evidence do I have that this is going to be a substantial move? And is the minus DI in control? Is the ADX line starting to show any strength? And so on. And you might have stood aside during this whole period because you don't have the additional supporting information of the patterns. Now we're going to go through the alerts, we're going to go through the confirmations, but I just want you to begin seeing the whole picture, seeing the other patterns that then could add additional information to what you are trading. Alright, on the 813 EMA entry and exit rules, you are going to have alerts setting up, and the alerts apply to any time frame chart. This is the same as I mentioned with the P3 and the P3.5, that you're going to see these same crosses and they're going to play out and be handled the same way no matter what time frame chart you're looking at. So the beginning point would be a CCI has dropped from being overbought in the case of a put trade, a cross down of the 8 EMA, or it's going to rise up from being oversold if you're considering a call trade. Now the PPO will also cross in the direction of the potential trade. The appropriate ADX DI line is going to be heading in the direction of the trade, meaning that the plus DI will be heading up for a call or down for a put, and the 8 EMA will be closing in on the 13 and look as if it is going to cross before too long. The confirmation signal, the buy signals, and these can be happening together, is the 8 EMA actually crosses over the 13, and that would be up for a call trade or down for a put trade. And this, I'll remind you, is an actual cross. It's not a bounce off of the line. You want to see the line cross and a little white space. And then you also want to have the ADX DI line to be heading and crossing in the direction of your trade. So the plus DI crosses up for a call, or it crosses down for a put. Your exit rules are, in a sense, going to be kind of in reverse. Again, you hopefully will have set a profit target, and it could be a line of support or resistance. It could be one of the pivot points that if it crossed up was near the actual pivot point, say at the time of the cross, then you might set your profit target for either R1 or R2, and when it gets to that point, take profit. Go ahead and close out the trade and move on to something else that is just beginning, rather than hang on for every dime that could be made. You will also see that the CCI will become overbought for calls. It'll be making the big green peak area up there, and it could be creating the brown area if you're in puts that it's oversold. And as they begin heading up toward either the 100 or the minus 100 line, that is showing that they're overbought enough they're beginning to show some weakness, and that would be an alert that it's getting to be time to exit. The PPO could seem to be weakening and nearing a cross down for calls or ups for puts, and you're going to start seeing negative candles. It might be positive candles for puts, or red negative candles if you were in calls, but this in conjunction with the other alerts is showing that the trend that you've been in is getting long in the tooth, and it's time to consider exiting. And as I've mentioned before, it's often better to go ahead and take your profits if it's hit the profit target. Take profits when you start seeing several of these alerts happening, rather than waiting for an actual cross down of either the PPO and the 8 over the 13, because you're going to be giving up some of your gains by waiting for those actual confirmation signals that it's over. It's sometimes better to just go ahead and say, well, I've had 2-3 alerts, I'm out of here. I'm closing the trade and moving on to something else. Here, there's lots to see on this chart. The strategy focuses on the actual crosses down. That here a bottoming process was, truly it was a topping process was taking place. You had a little bit of a cross here, but not very much white space, but a little bit, and you had a cross back up, and then here we come with the kind of official cross down and it gapped down at this point. I'm going to point out here, and I don't want you to get confused by my combining patterns. Again, this is just to take this opportunity to be able to point out the patterns, because the more charts you look at and the more often you recognize the various patterns, the more your eye will become attuned to seeing them, and it will become an automatic thing. So here we had a P3 form as the price was dropping. The PPO and the ADX lines spread apart and went into that adult stage where they're spreading apart here. Then we had a P3 form, and then here now we had another P3 and a half form as the PPO crossed down, and this initial squeeze re-squeezed. It kind of failed as the PPO crossed down, and here it tightened again. And we can see that the minus DI line is definitely in control, and that is this real strong leg down. So we had our 813 cross down. This is where we would have gotten in. We couldn't have gotten in before the cross and this drop, but we would have entered right here. You would have come down, and at this point, because it has formed a squeeze and has had a PPO cross up, would have been one of those kind of signals, an alert to us that this has reached the bottom and it's time to exit. This would have been a P3 that was playing out, and yet what we are trading is not this pattern itself, but we're trading the 8 and 13 cross up. So again, we would have gotten in. We couldn't have caught it before this gap. We would have entered here on this gap up, but simultaneously we know and can see that the P3 squeeze is playing out. So we enter here, and we're just keeping this simple. We're following the 8 and 13 EMA lines, and as long as they are not crossing, they can have a test like they did here. Here's another test. Here's another test. And then over here is where they actually crossed and headed down, or would have been our exit place. That I've made a note, and had we set a target, we entered here, we perhaps would have, as the trade was, we got in and was proceeding, we could have used this area of R2 as our profit target, and this would be the area that we were considering getting out, was when it hit the area of, say, 64.57. In the case that the EMAs were still looking so strong and there was so much space between them, we could have then held until it got to that area, which is into the next week. So we're working with different pivot points and so on, but we would have exited right here and said that it got above this profit target right here, and this is, we would have been happy with this profit between here and here, and it would have been a nice trade, and we would have missed this stress of, oh dear, you know, it really dropped. Why didn't I get out when I should have followed the rules up here of it hit my profit target? I should have entered or exited. And yet, had you held through this, waiting for an actual cross down, then you would have been in a trade for a few more days, had another test of the EMA line, and would have gotten out somewhere in here, which in a sense is the same area that the earlier exit would have been, and it's just that you would have had your money tied up for 1, 2, 3, 4, 5 more days, but you would not necessarily have gained any additional profit out of it. It would have worked out to be just about the same, and you might have lost a little time value. So sometimes it just pays to get out when it hits your profit target, when you are seeing some signs of weakness. Even if it regains its second wind and continues on, it's easier to get out and move on to something that's fresher and new. So on that particular trade that we just followed, that had you entered on November 19th and purchased the December 12th 64 strike calls, the premium was 86 cents. And on the days until expiration were 25. The delta was 46. Now, had you entered or exited on the first exit that we mentioned on November 27th, the premium, the bid premium was $1.46, and so that's 60 cents profit, or 70%. The delta at the time of the exit was 67, and there was still 17 days left till expiration. Now, had you held until the second exit on December 4th, the premium would have been $1.84, which was a profit of 98 cents, or 114%. And at that point, the delta was 79 at the time of the exit, and there was 10 days left until expiration. We are now going to talk about the M's and W's. Another name would be double tops and double bottoms, but I like to call them marvel and wonder patterns because they truly are. They can be marvelous as far as their profit and just wonderful trades. But there's two types of M's and W's, so it gets more complicated for me to be able to say, well, it's a double top with a twist or whatever. And so this is just my way to give them names and become personally involved with them, if you want to say. Now, again, I'm going to point out the squeezes because often the P3 squeezes and the P3.5s are what helps the M's and the W's to form. So I've drawn circles down here, and the first squeeze was a very, very tight one, and yet it re-squeezed rather quickly. So here's the momentum that began on that squeeze, and then it re-squeezed to test this level of support, and it actually broke through. And this is what formed the first peak of the W, is this second squeeze as it tried to unfold and play out. So here the lines are spreading apart, but because you know what you know about the stages, here it re-squeezed by having a PPO cross down, and the lines are coming in close together again. It never went through stage 6 and 7. There's no point here where the PPO and the ADX lines ran parallel to each other, where the ADX line got in support of the plus DI, that the lines kind of just flattened out and the price rose as much as it could on the momentum of the PPO. But you can see here the plus DI and the ADX line never got involved. They neither took control until the minus DI line started rising here, and so too the ADX line started rising, which is what resulted in this second dip down to create the second point of this W that was forming. So stepping back again, just to bring your eye into focus and seeing, we had the P3 squeeze. As it started forming, we were creating, in a sense, a P3.5. When the PPO crossed down, we instantly went into that sixth stage. So the 1, 2, 3, 4, 5 stages happened really fast here, and it went into this sharp drop. We had a second squeeze form. Then we have the lines coming together, and here on this second failure or re-squeeze, we have another stage 6 of the P3.5, and then finally we have a PPO cross and the P3 that went through the stages. See how the lines are parallel here on this squeeze? We never had that here, we never had that there. This is original squeeze, re-squeezed 2 times before it went through the 7 stages, and then here it expired. Now I'm going to talk about what happened as far as that expiration in just a second, but for the pattern of the W, we have the peak here, and this could be an entry as we are forming the second side, the right hand side of the W. Now there's a way to measure an expected move with a W pattern. You measure from what would be the peak here in the middle of the W down to the lowest portion of the W, and the dollar distance between here and here is added to the middle peak, and that then is your projected target. So I don't know if I can do this. Let's just say that it's 45.50 down to 42. So that would be $3.50, and so we would add $3.50 to 45.50, and that would bring us up here to our to a profit target. Now it actually went a little bit higher than that, which is great, and it sometimes does, but it gives you an idea of what the upside will be. So an exit entry here, as it started, we have a PPO cross, and as we have the positive candles moving up. A second entry could have been as it crossed above the middle of the W. So right in this area would have been a second entry if you had not gotten in, or if you wanted to take a second position as it crossed and confirmed that the W was a viable and confirmed pattern. This is another excuse me, another time frame. This is a 30-minute chart, and one might hope that the W patterns or the M patterns would be very, very distinctive and be deep peaks and so on, but when you allow yourself to use a little bit of your imagination, you can see that this created a low, it went up, and now it went back down and tested that same level of support, and that is what created the second peak of this W, and then we have the leg up. So that you could have had an entry here, which actually was quite close then to what the middle area would have been, and it continued to climb and then went flat for a few days. We can look, because we're learning about how the patterns confirm each other. Again, we have a P3 here. You could say that this was perhaps the original squeeze, went up just a little bit, re-squeezed right here, crossed back down, and now this is the re-squeeze that is actually going to play out, and it went through all the stages. See, here's the parallel lines of the adult stage, and here's a couple of the stage 5 toddler wobbles. The plus DI stayed in control. Here's another one. This is a 60-minute chart. You have your left peak, there's the rise in the middle, a test of this lower support area, and then you have the rise up. We would have had a P3 here, a little re-squeeze, another one, and then this went through the stages, the 7 stages of the squeeze. The plus DI line was in control, and then there was another leg up here. So entry on the W pattern would have been right here, based on the measurement between the peak and the low of the pattern. You would figure that amount and add it to the peak, and so your target is right in this area. You could also say that it was the R1 level, and as it moved through and went up and hit that level, that actually is where it kind of flattened out. And so you could have exited right here because it hit your profit level, and rather than have your money tied up in whatever was going to happen next here, you could have exited at that point. Or because there was not and 8 EMA cross over the 13, you could have stayed in, providing your expiration length was long enough. You could have stayed in for this second leg up. And now you have a PPO cross down, you have the CCI dropping, the RSI is dropping, and so you would exit right here, and that would have given you a bit more profit. We'll look at some of the Marvel, the M trades. They work in the same way as the W's, just in reverse. Here you have this peak, and you have the right hand side peak, and then the drop. Now I'm going to point out here that you want the right hand peak to either be equal or higher than the left hand peak. And on the W's that we looked at just a few moments ago, all of the right hand peaks of the W were either quite level with the left hand side, or they were a little bit lower. That is what makes a double top or a double bottom, is for them to be either rather precisely the same height or bottom, or the right one to be a little bit stronger, where it tested a little higher or tested a little lower in the case of the W's. And again, I am just pointing out, and I'm going to quit talking about them. But you can see the circled areas are P3 patterns. There's a re-squeeze. Here it went up and it had some wobbles. The DI line kind of gave up. There's another squeeze, and here's a re-squeeze, another squeeze. And so we're not trading these, but they can give information to what you are trading. You can look at this and see what stage it's in, and know that here the plus DI hasn't even crossed up. You have a test of the PPO line, and we're seeing that this goes flat, and it very well could drop further because this DI line has not taken control. So there's a way to figure an estimate of a profit target with the M patterns, just as there was in the W patterns, that you would measure from the lowest, or in this case the highest point, down to the middle, and whatever that dollar amount is between 46.50 and 43, $3.50, you would add that to the 43 and come up with 46, or I'm sorry, subtract it from that and end up with 39.50 would be the profit target for this pattern. It's not quite there, so it may drop further. It may drop down here to S1 before it actually is finished. Here's a daily chart, and I'm doing this in various time frames so that you can see that the patterns are the same, that they happen over different periods of time based on the time frame that's being used. Here you have the left peak of the M, and you can see that the right peak of the M right here is a little bit higher, just a smidge, but it went up just a little bit higher, and that's what you want to see, either almost exactly the same or just a little bit higher, or in the W's a little bit lower. So you can do the same thing. You can measure between the topmost peak and the middle and subtract that, and that gives you your profit target. And just notice the circles are the P3s or the P3 and a halves, so that your eye starts to see them. Alright, on the Marvel entry for entry and exit rules, You will notice the price on the chart has reached a similar point or to a previous top, or is a little bit higher. The CCI is overbought and above 100. There are one or two red candles that's showing that we're perhaps ready to build the right leg down of the M. Your entry confirmation is the CCI drops below 100. There is a candle close below the 8 EMA. These two entry confirmations give the earliest signals, and yet it can be the riskiest entry, that before you have a PPO cross down can be premature, but they give you the earliest signals, and if you're a risk taker, you could enter prior to a PPO cross. When you actually have the 8 EMA cross over the 13, this is the least riskiest, and you can see how all of these strategies kind of tie in together. That in the last strategy we were talking about 8 and 13 EMAs being a cross for entry and exits. So the M and the W is a different pattern that your eye can pick out, but it's using some of the same elements from the earlier strategies. The second entry in this trade could be when a candle closes above the middle level of the M. Exits now are when it meets your profit target for the pattern. It can be a cross up above the CCI minus 100 line. This could be an early exit, but any exit where you can take profit, there's nothing early about that. Profit is profit, and you're pleased to be making this money. Another signal could be the PPO cross down and a cross up of the 8 over the 13 EMA. This can be a surer signal, but it also can mean that you're giving up some of the profit if you had exited a little bit earlier. It eliminates false exits, but at the same time, if you wait for that signal, you can be actually giving up a certain amount of profit. This is an M trade that we're going to look at. This is a 30-minute chart. Again, it's not I don't want to say hard to sometimes see the peaks, because once you know what you're looking for, you can spot areas that here you have a number of candles at a high area. Then it drops down. You had a test of that same level of resistance. It wasn't enough to hold, so it dropped down further, went back up to that same price level. You can see by the pivot points from the previous period that it went right up to that same level, had a couple candles, and then we started heading down, so that your eye will pick up that this is a point and this was a point. This was kind of a rogue candle, and this was the bottom of the middle of the M. You would enter here, and this is our exit. Earlier we can sit and see that it was overbought, that this is our CCI, and it crossed down below that 100 line. We had a PPO cross. We've had the minus DI cross up and take control, and it's in control for this whole leg down. It is at this point when it crosses down and the plus DI crosses up, confirms with the other signals like a PPO cross that this is where we are exiting the trade and taking profit. If we had entered on December 13th and purchased the December 1265 strike puts, the premium was 66 cents. There was 8 days until expiration. The delta was on December 14th, actually just 1 day later because this was an intraday chart. The premium was $1.07. There was 7 days left until expiration. The delta had increased to 67 in that period of time, and the profit was 41 cents or 62%. And so that is not bad profit for a 1 day trade, and being able to purchase a number of contracts that would have cost 66 cents per share or $66 per contract that you probably with the average portfolio would have been able to perhaps buy 10 contracts for $660, and in the course of that 1 day you would have made $410 or 62%, taking that day trade off of that M pattern. The W has its own set of alerts and confirmations for entry and exit. You will begin to notice the price on the chart has reached a similar point to a previous peak, to a bottom level. We're looking at the bottom peaks of the W. The CCI is oversold and below minus 100. And there may be 1 or 2 up candles that shows that there may be a trend reversal. Entry confirmations are a CCI moves up above minus 100, a candle close above the 8 EMA. Now these would be the earliest and the riskiest. If you do this before a PPO cross, this is a slight risk that it may bounce off of the PPO and head another leg down. Then the least risky would be an 8 EMA cross up and over the 13, and waiting for this later confirmation is going to give up a certain percent of the move because it will be well underway at that point. A second entry is when you have a candle close above the middle point of the W. Now the exits are that it has met your profit target for that pattern, across down below the CCI 100, and this could be an early exit, PPO cross, or a cross of the 8 EMA over the 13. And this is the surest of the signals. It is a later exit. It helps to eliminate any false exits, but at the same time you can give back a little bit of profit if you wait for the 8 to cross over the 13 before you exit. We will look at a W trade here. This is the pattern that has formed, that we were able to see the left peak here. This is the peak of the W. It dropped back down. It went deeper than the left side, the right side did. It went deeper. This is our entry. Our price targets we could measure and then add that to that would be in this area, or in the case of this we could have waited till it hit this R1 pivot point. We can see that we had a squeeze. I just can't help myself. We had a squeeze that went through the stages, and we could use this information to help us stay in the trade rather than exit right here. We could have stayed in until this point when we started having the PPO rollover. So let's see how this target or trade played out as far as our profit. An entry on June 28th, the purchase of the July 1263 strike calls, the premium was 63 cents. There was still 22 days before expiration, and the delta was 39. On this trade, we exited on July 5th. The premium was $2.80. 18 cents. There was still 15 days left before expiration. The delta had increased so that it was now 80, and there was a profit of $1.45 or 230%. That worked out to be a really nice trade. Now this is the Marvel variation pattern, and right off the bat I'm going to show you what the difference is from the M pattern that we looked at earlier. You have your left peak of the M, and this group of candles right here is, or actually right here, is the middle of the M. It's climbed back up, and it almost touches or gets as high as this left side, but not quite. It's a little weaker. That this rally, this uptrend, this area that is going up to test this resistance area is a little on the weak side, and then it goes down and creates the right side of the M, and it reverses and heads back up. It doesn't continue down in the way that an M did, and that's the point of this variation, that when the right side is weak, it does the opposite of what the other pattern did. The M pattern went up, created a middle, went up even or deeper, higher, and then dropped and went down, 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 and we were able to measure the target and subtract it and so on and come up with a target that would have been down here for the pattern. In the case of the Marvel variation, the right side of the M is weaker or shorter, not as high, and after the drop that creates the right side of the M, it continues on the direction of the earlier upward movement that created the middle, and so that then you have this nice ride. There's two entries on this. You could get in and ride this down knowing that it's going to be a shorter trip, a shorter leg on the right side of the M, and then you can also get in for the upside portion of the reversal, the trend reversal that happens with the Marvel variation pattern. And then I point out that there's the squeeze. It's not a super tight, and but you can still pick it out. Here's the cross, and look, it's this stage 6, this adult stage in the squeeze, that is creating and helping to support or playing out and confirming this uptrend that's happening in this M variation pattern. Here is a W variation pattern. So we have the left side, we go up in the middle, we drop down here to create the right side of the M, and it doesn't go as low as the left side, and it doesn't go lower than the left side. It's weak. It goes down. It doesn't get to this support level to really give it a good test, and it pops up and it creates the right side of the W, but instead of continuing up and going higher than the middle point, it goes up and then it reverses. So that you have, again, two trades. You can get in here on the creation of the right side of the W, and then you can also get in on the reversal that happens when you have a variation W pattern. And I am just such a chart nut. You can look and see that this is trading in a range, that it is popping back and forth between, it's like a zigzag between this support level, or resistance level and the support areas down here. Again, to just draw your eye to it, there's squeezes that are forming, another squeeze that's forming here, another squeeze that's forming there. If your eye is starting to become accustomed to seeing the spread that happens when the prices drop, here you have a P3.5. There was a little test of the PPO line. Here is a P3.5 playing out. There's the spread that happens in the strong drop right at the end of the pattern, the stage 6 before the 7th stage. Here you have another one. This is the forming. Here's the spread apart of the ADX and the PPO line, this strong drop that's happening right here. And that's how you're seeing it forming and taking place on the chart.